Welcome back to the channel, where we peel back the layers of the financial world to find the truth beneath the surface. Today we're exploring a milestone that many dream of, but few truly understand the psychological impact of achieving. We're talking about that incredible moment when you make your very last mortgage payment, and the bank no longer owns your roof. On paper, it seems like a simple math equation. Your liabilities decrease, and your net worth becomes more tangible and stable. But in reality, the shift that happens inside your mind is far more profound than the numbers on a balance sheet. Paying off a home isn't just a financial victory. It's a total recalibration of how you perceive risk, reward, and time. For decades, your primary financial driver has likely been protection, ensuring you have enough to cover the monthly nut and keep the lights on. When that obligation vanishes, the survival brain begins to hand over the controls to the thriving brain for the first time. Suddenly, the thousands of dollars that used to vanish into interest and principal are sitting in your account, looking for a new home. In this deep dive, we're going to analyze why house rich is a psychological gateway to becoming wealthy in every sense. We'll look at the macroeconomic trends of housing and why the American dream of ownership is evolving in a high-inflation era. Think about the psychological weight of a 30-year commitment. It's a marathon that dictates every career move and spending habit. Many people find that once the mortgage is gone, their tolerance for investment volatility actually increases because their floor is secure. We'll explore how this newfound security allows for more aggressive, innovative thinking in your business and personal ventures. We'll also tackle the opportunity cost debate. Should you have invested that extra cash in the S&P 500 instead of the house? While math might favor the market, the psychological peace of mind often provides a return on ego that is impossible to quantify. Imagine waking up knowing that no matter what happens in the stock market, you are the absolute king or queen of your castle. This sense of permanence creates a wealth fortress that changes the way you negotiate your salary and your future. Throughout this video, we'll use real-world data and behavioral science to show you how to navigate this transition effectively. If you're ready to learn how to turn your home into the ultimate launchpad for generational wealth, let's get started. First, let's address the elephant in the room, the crushing weight of modern debt culture and its effect on our stress levels. Studies show that housing costs are the #1 source of financial anxiety for the average adult over the age of 30. When you remove that stressor, your cortisol levels drop, allowing for clearer long-term strategic planning and better decision-making. Financial literacy isn't just about knowing how to trade, it's about understanding how your environment dictates your choices. A person with a paid-off home sees a market crash as a buying opportunity, while a person with a heavy mortgage sees it as a threat. This is the wealth effect in action, the psychological phenomenon where people spend and invest more when they feel their assets are secure. We'll break down how to avoid the lifestyle creep that often follows the end of a long-term debt cycle. It's tempting to take that mortgage money and buy a luxury car, but the Finora way is to turn that cash into a money printing machine. We're going to look at the 3 pillars of post-mortgage wealth: reinvestment, diversification, and philanthropy. By the end of this story, you'll see your home not just as a place to live, but as a psychological anchor for your freedom. Let's look back at the history of interest rates and how they've shaped the mindset of different generations. In the 1980s, high rates made paying off debt a mandatory survival tactic, creating a generation of disciplined savers. In our modern era of fluctuating markets, that discipline has become a superpower for those who can master their own psychology. I want you to visualize your financial journey as a mountain climb, where the mortgage is the heaviest pack you're carrying. At the summit, you drop the pack. Now, how much faster can you run toward your next big goal? This transition is where many accidental millionaires are born, simply because they didn't stop their momentum. We will reference the wealthy barber philosophy and how small, consistent actions lead to massive psychological shifts. We'll also discuss the impact of local property taxes and maintenance, the hidden costs that remain even after the bank is gone. Strategic money management is about looking at the full picture, not just the monthly payment. Now, let's dive into part 2 of our narrative, where we analyze the specific risk shift that happens in your brain. Now, let's get into the gears of the human brain and look at the neuroscience of debt-free living. When you have a mortgage, your subconscious mind is constantly running a background program calculating your survival runway. Every time you see a headline about layoffs or a market dip, that background program spikes your adrenaline, even if you're safe. Once the house is yours, that program finally shuts down, freeing up massive amounts of cognitive energy for creative problem solving. This is what high net worth investors call the sleep at night factor, and it is a powerful catalyst for bold investment moves. Think about the math. A $3,000 mortgage payment isn't just $3,000, it's actually about $4,500 of pre-tax income for most people. When that liability vanishes, your effective income doesn't just go up, it explodes in terms of investable surplus. Many people fall into the trap of thinking they should have kept the low-interest debt to arbitrage the market returns. But arbitrage is a mathematical theory, whereas living in a paid-off home is a psychological reality that changes your behavior. Behavioral economists have found that people with zero debt are 40% more likely to start a side business or pivot careers. Why? Because the cost of failure has been drastically lowered. You will always have a roof over your head. This safety floor allows you to stop playing not to lose and start playing to win in your professional life. Let's look at the concept of the leaking bucket. Debt is a hole in the bottom of your wealth-building container. No matter how much water you pour in through your salary, the hole is constantly draining your potential energy and time. Patching that hole with a final mortgage payment allows every new dollar to sit, settle, and begin the magic of compounding. We often hear about the 8 wonders of the world, compound interest, but few discuss the friction that debt applies to it. When you are debt-free, your compounding is frictionless. You are no longer swimming against the current of a 6% or 7% interest rate. Consider the story of the millionaire next door. Most of them didn't have high-risk portfolios. They simply stayed debt-free for decades. They understood that a house is an illiquid asset, but the cash flow it releases is the most liquid power you can possess. In this section, we are going to analyze how to reallocate that former mortgage payment into a diversified freedom fund. Many people ask, should I put it all in index funds or should I look at higher yield alternative investments? With your primary residence secured, you now have the psychological bandwidth to explore things like private equity or real estate syndication. You can afford to wait for 5 to 10 years for a payoff because your daily survival isn't tied to that specific capital. This is how the wealthy think. They match their asset duration to their life goals rather than their monthly bills. Let's talk about financial confidence. There is a specific posture people take when they truly own the ground they stand on. This confidence translates into better negotiations at work and a more patient approach to the stock market's inevitable red days. During a recession, most people are selling in a panic to cover their debts. You, however, will be the one buying their fear. This is how generational wealth is transferred, from the stressed and over-leveraged to the patient and the debt-free. We must also address the tax implications. While you lose the mortgage interest deduction, your net cash position is usually much higher. We'll look at how to use tax-advantaged accounts to shield your new surplus and keep more of what you earn. Remember, it's not about what you make, it's about what you keep, and the mortgage-free life is the ultimate keep strategy. Let's pivot to the impact on family. Owning your home outright creates a legacy of stability for the next generation. It teaches your children that wealth isn't just about flashy consumption, but about the ownership of time and space. Imagine the lessons you can pass down when your financial discussions are about growth rather than payments. We are building a culture of ownership within your own household, and that starts with the deed to your front door. Some critics say that home equity is dead money. I argue that it is foundation money, the bedrock of your empire. You can't build a skyscraper on a swamp of debt. You need the solid concrete of equity to reach the heights of true independence. In the next few parts, we will look at real-life case studies of people who chose the peace path over the leverage path. Their stories will highlight the unexpected joys, like the freedom to take a sabbatical or the ability to give generously to charity. Stay with me as we break down the specific portfolio structures that work best for the newly house-free investor. As we enter this next phase, we have to dismantle one of the biggest debates in finance, the opportunity cost of home equity. Mathematical purists will tell you that if your mortgage rate is 3% and the stock market returns 10%, you're losing money by paying it off. But this spreadsheet logic ignores the human factor, specifically how many people actually invest that difference every single month without fail. Most people don't. They succumb to consumption creep, spending the extra liquidity on lifestyle upgrades rather than wealth-building assets. A mortgage is essentially a forced savings account that builds equity while you sleep, providing a safety net you can't easily spend. Once that forced mechanism is gone, you need to replace it with an ironclad automated investing strategy to maintain your momentum. Without a monthly bill to pay, your greatest risk isn't the market, it's your own lack of discipline with the new surplus. This is why investment psychology is more important than investment math. It's about what you actually do with your capital. Let's look at the wealth pyramid. Your paid-off home forms a wide, stable base, allowing the tip of the pyramid to reach higher. Now that your base is secure, we can discuss aggressive asset allocation for the funds that used to go to the bank. Consider the rule of 72. If you reinvest a $2,500 monthly payment into an 8% return, that money doubles every 9 years. Over 2 decades, that single decision can result in millions of dollars of additional net worth that you otherwise would have ignored. This is the accelerated compounding phase of your life, where your wealth grows exponentially because you've removed the friction of debt. We also need to talk about macroeconomic resilience. In a world of rising property taxes and insurance, ownership is your best defense. While you still have to pay the government's rent through taxes, your exposure to inflationary housing costs is effectively capped. This makes you inflation-proof in a way that renters or those with massive adjustable-rate mortgages can never be. Let's examine the psychology of the windfall. Many people feel a high after the last payment, leading to impulsive luxury purchases. I want you to treat your mortgage payoff as a corporate merger. You've just merged your labor with your property to create a new entity. This new entity, Your Life Inc., now has a much higher profit margin because your operating expenses have plummeted. How should a high-margin business invest? It invests in R&D, new market sectors, and long-term sustainability. For you, R&D might mean taking a course to learn a new high-value skill or starting that digital business you've been dreaming of. New markets could mean diversifying into international stocks or emerging technologies like AI-driven ETFs. Sustainability means ensuring your emergency fund is topped off and your insurance coverage is optimized for your new net worth. We are shifting from paying the bank to making the world pay you. Let's look at a case study from the 2008 financial crisis. Families with paid-off homes were the ones who survived and thrived. They didn't lose their homes to foreclosure, and they had the cash flow to buy blood-in-the-streets assets at massive discounts. This is the anti-fragility concept coined by Nassim Taleb. You actually gain from disorder because your downside is protected. When the economy gets shaken, the people with the most debt fall off the tree. The people with equity take root. We also have to consider the intergenerational wealth aspect of a debt-free home. In many cultures, the family home is the primary engine of upward mobility, providing a rent-free base for the next generation to start. By paying off your house, you are giving your children a head start that is worth more than any inheritance check. You are teaching them that freedom is the ultimate luxury, not flash. Now, let's look at the tax-free capital gains benefit when you eventually decide to downsize or sell. In many jurisdictions, the gain on your primary residence is sheltered, making it one of the most tax-efficient investments on Earth. You are essentially growing a tax-free bucket of wealth while simultaneously lowering your daily cost of living. It is the only asset where you can live inside your investment while it appreciates and provides psychological utility. Let's talk about mental bandwidth. Every debt you owe is a loop left open in your mind, consuming RAM. Closing the mortgage loop is like upgrading your internal processor. You think faster, more clearly, and with more vision. You start to see opportunities where others see obstacles because you are no longer blinded by the need to pay. In the next segment, we will build your day one investment plan for the first month after your mortgage disappears. Welcome to the identity shift phase, where we look at how your self-image changes when you finally hold the deed to your land. For most of your adult life, you've likely been identified as a borrower, a person whose labor is partially owned by a financial institution. The moment that mortgage is satisfied, you transition into the role of a true owner, and that changes the way you carry yourself. Psychologically, this ownership identity acts as a shield against the consumerist pressure to buy things just to feel a sense of status. You no longer need a luxury car to feel successful because you have the ultimate status symbol sitting on a foundation of concrete and wood. Let's discuss retirement compression, the phenomenon where your FIRE number drops significantly because your cost of living is so low. If your lifestyle costs $5,000 a month with a mortgage, but only $2,000 without it, your required retirement nest egg shrinks by 60%. This means you might be able to retire 5, 10, or even 15 years earlier than you originally planned. We are effectively buying back your time by eliminating the single largest expense in the human budget. Now, we must address a controversial tool, mortgage equity withdrawal, or the home equity line of credit, HELOC. Many financial advisors suggest using your equity as a cheap source of capital to invest in other high-return assets. While this can work for the hyper-disciplined, for many, it simply reintroduces the very debt stress we just worked to eliminate. My philosophy is peace over points. The mathematical spread you might gain isn't worth the psychological risk of losing your fortress. However, having an emergency HELOC in place, unused, can act as a powerful secondary safety net for unforeseen catastrophic events. Let's look at the wealth velocity concept, how quickly your net worth moves once you are no longer paying interest. Without a mortgage, you can weather long periods of unemployment or market downturns without ever feeling the squeeze of insolvency. This allows you to stay invested during the worst of times, which is exactly when the greatest wealth is generated. History shows us that those who panicked and sold in 2020 were often those who had high monthly overhead and low cash reserves. You are building a resilient portfolio that is decoupled from the stress of the monthly billing cycle. We should also explore strategic philanthropy, the ability to give back to your community in a way that wasn't possible before. When your own Maslow's hierarchy of needs is met at the base level of shelter, your brain naturally looks toward self-actualization. Giving becomes an investment in your own legacy and a source of deep psychological fulfillment that money in a bank cannot provide. We'll reference the giving pledge mindset, how the world's wealthiest individuals prioritize impact once their security is absolute. Now let's pivot to the downsizing strategy, using your paid-off home as a massive cash cow for your later years. Selling a large family home and moving to a smaller, more efficient space can unlock hundreds of thousands of dollars in tax-free cash. This geographic arbitrage allows you to move to a lower-cost area while keeping your standard of living incredibly high. You are essentially harvesting the years of discipline you sowed into your mortgage payments. Let's look at estate planning. A paid-off home is the simplest, most powerful asset to pass on to your heirs via a trust. It avoids the complexity of debt settlement after you're gone, ensuring your family has an immediate, stable asset base. We are talking about generational momentum, giving your children a foundation that is already built so they can aim higher. Consider the psychology of choice. When you don't have to work to pay the bank, the work you choose to do becomes better. You become more selective, more creative, and more daring because your survival is no longer on the line every Monday morning. This optionality is the truest definition of wealth, the ability to say no to things that don't align with your values. We'll analyze the modern nomad trend, people with paid-off homes who rent them out to fund a life of travel and global exploration. Your home becomes a passive income engine that provides for you, rather than you providing for it. Let's discuss the maintenance reserve. Now that the mortgage is gone, you should redirect a small portion to a home health fund. Treating your home like a capital asset requires scheduled maintenance to ensure its value continues to outpace inflation. This proactive approach prevents deferred maintenance from eating into your equity when you eventually decide to sell. We are moving toward a total wealth overview, where your home is just one piece of a much larger dynamic machine. Stay with me for the final session where we map out the exact exit ramp from the working world into total financial sovereignty. As we reach the final chapter of our journey, it's time to build the day one post-mortgage investment blueprint. The very first month you don't send that check to the bank, you must pay yourself first with that exact same amount. I recommend a tiered reinvestment strategy that balances immediate growth with long-term capital preservation. Tier 1, maximize any remaining tax-advantaged space, such as a Roth IRA or a 401k, to shield your new surplus. Tier 2, allocate 50% of the remaining cash into a low-cost broad market index fund to capture steady market returns. Tier 3, set aside 20% for opportunity capital, cash that sits in a high-yield account waiting for a market correction. Tier 4, use the final 10% for lifestyle dividends, small rewards that reinforce the psychological victory of being debt-free. This structure ensures that you are growing your wealth while still enjoying the fruits of your decades-long discipline. Let's look at the wealth multiplier effect of this strategy over a 10-year horizon, compared to keeping the mortgage. By investing the payment, you are essentially buying a second retirement fund that grows silently in the background. We must also consider the psychology of generosity as a wealth-building tool for the soul. Research shows that pro-social spending, spending money on others, increases personal happiness more than personal consumption. Now that your fortress is complete, you have the capacity to be the chief financial officer of your community's future. Think about the innovative thinking that comes from a place of total security, rather than constant scarcity. You can afford to take calculated risks on new technologies, startups, or environmental initiatives that align with your values. This is how the new elite are being formed, not through high-leverage gambles, but through low-debt sustainability. We've analyzed the math, the neuroscience, and the macroeconomics of a mortgage-free life. The conclusion is clear. While debt can be a tool for growth, equity is the engine of true, unshakable freedom. You are no longer just a participant in the economy. You are a sovereign entity with the power to dictate your own time. Remember the words of the great Stoics. Wealth consists not in having great possessions, but in having few wants. By eliminating your largest want, the need for a bank's permission to live in your home, you have achieved a Stoic victory. Let's finalize your action plan for the next 90 days to prepare for this transition. Step 1, audit your current mortgage balance and set a freedom date on your calendar. Step 2, research the standard deduction changes in your area to prepare for the loss of interest write-offs. Step 3, automate your brokerage transfers so that the mortgage money never hits your checking account for long. Step 4, celebrate. Not with a big debt-funded party, but with a moment of quiet reflection on what you've achieved. You have done what only a small percentage of the population ever manages to do. You have escaped the debt trap and built a foundation that will support you and your family for decades to come. As you move forward, keep the Finora mindset of patience, discipline, and strategic investigation close to your heart. The world of finance is complex, but the path to freedom is surprisingly simple. Own your time, own your space, own your future. I want to thank you for joining me on this deep dive into the psychology of mortgage-free life. If this narrative has helped you see your home in a new light, please share it with someone who is currently on the climb. We are building a community of wealth builders who value peace of mind over flashy spreadsheets. In our next video, we will explore the hidden assets that the 1% use to protect their wealth during high inflation cycles. Make sure you're subscribed so you don't miss that strategic breakdown. The journey to financial independence is a marathon, but the view from the finish line is worth every single step. Look back at how far you've come and look forward with the confidence of a true owner. Your home is now more than 4 walls and a roof. It is your launchpad to a life of infinite possibility. This is Finora Finance, signing off for today. Keep building, keep growing, and keep dreaming. I'll see you in the next chapter of your wealth building story. Goodbye for now.